Hello everyone and welcome to our CCH Networks webinar, ATO Focus on Pharmaceutical Sector. I'm Tony and I'll be your moderator. Your presenter today from the ATO is Sandra Farhat, Assistant Commissioner. The session will be facilitated by Chris Kinsella, partner from Minter Ellison. In today's webinar, Sandra will be covering the ATO's Pharmaceutical Strategy and recent ATO developments. You can submit questions via the Questions tab at any time throughout the webinar. If we don't get a chance to answer all your questions, we'll be sure to follow up via email or phone post the webinar. I think we're ready to begin, so I'll hand you over to Chris.
Thank you, Tony, and good afternoon to everybody joining this webinar. I must say I was delighted when we were looking at putting this webinar on. We had anticipated that there would be probably between 20 and 50 people who might dial in. I'm pleased to say that the response rate has been well in excess of that, and we have close to 250 people who registered for this webinar. So there is a lot of interest in this topic this afternoon, and the question is, why is that? It may in part be attributable in no small part to the high interest in the pharmaceutical sector at the moment by the Commissioner. Some of you may have seen that Mark Conzer was before the Senate References Committee in late August this year, where he mentioned that there is currently 20 active files in the pharmaceutical industry. And today we are very fortunate to have Sandra Farhat with us. I'll introduce Sandra in a moment to expand on the ATO's focus on the pharma sector and the broader issues that come out of that. So also, some of you will be aware that the Economics References Committee had a number of inquiries into corporate tax avoidance, and there were many submissions received by that committee, and that included a number of pharma companies, about 10, appearing a couple of years ago before that inquiry. So this process has been going on now for some years. So with us today is Sandra, and to introduce Sandra formally, she's an Assistant Commissioner in the Public Groups and International area of the ATO. She's responsible for ensuring the compliance of public and foreign-owned entities and has strategic responsibility both for e-commerce and the pharmaceutical industries, with a specific focus on transfer pricing. And she's had over 16 years experience with the ATO. Sandra has a comprehensive slide deck to work through this afternoon, covering a broad range of topics. We should say at the outset, if anybody has questions at any stage, they should feel free to send those through. You can't speak to us, we can only speak to you, but we will see those questions and we will endeavour to deal with those as they come through. So you are encouraged to submit questions if you wish to. So without further ado, I will pass over now to Sandra to start the presentation.
Thank you very much, Chris, and thank you for the opportunity today to talk through both the ATO's pharmaceutical strategy and also highlight some recent ATO developments, particularly in our strategy insofar as it relates to both public groups and international, and by extension, pharmaceutical companies. Chris has comprehensively introduced me. I am an Assistant Commissioner. I have strategic oversight for the pharmaceutical strategy as well as the e-commerce strategy, and I have a broader role within public groups and international, running operational compliance teams who undertake pharmaceutical, e-commerce and broader compliance activities. So I will start the presentation. As Chris said, it is a lengthy one. There are quite a few topics to go through as per the original invite. So we'll do our best to stick to the content. Happy to receive questions as we go along on the topics that we're going through. We've structured the slide deck to align with the original invitation. So if there are questions that relate to topics on that invitation, it might be best to wait until we actually get to those topics, and we can do a wrap up at the end as well if there are any questions that remain. So pharmaceuticals represents one of our major inbound supply chains. An inbound supply chain as itself represents one of public groups and international's three major risks. Those risks include related party financing and outbound marketing hubs. So there is a significant interest in pharmaceuticals as part of our inbound supply chain strategy. Again, it's not an isolated matter, and it can't be considered in isolation, which feeds into why the content as per this slide is quite broad and diverse. Pharmaceuticals really is just part of a larger and holistic strategy to manage public groups and multinational tax compliance. But hopefully today we will get to run through what's on the contents page. We plan to talk about Justify Trust and the Top 1000 program, give practical insights into our pharmaceutical strategy, particularly specific pharmaceutical risks in relation to transfer pricing, R&D and R&D offsets, mergers and acquisitions. We'll also touch on advanced pricing arrangements and some key learning and best practice points insofar as they relate to APAs. We'll touch on the ATO's advancements in relation to tax transparency and some of the key measures there in relation to country-by-country reporting and reportable tax positions. We'll also touch on the Diverted Profits Tax, some of the key messages, and maybe if we get time, run through some examples. And then we'll sum up with some best practice risk management, which is really what can taxpayers do and what should they expect from the ATO and the ATO response to certain behaviours. Again, at a really broad level, there's been some significant policy shifts and legislative amendments in the post-BEPS world in relation to transparency and tougher laws to close loopholes and give the ATO stronger powers to deal with multinational tax avoidance and broader public groups and international tax avoidance. Specifically, the ATO has a tax avoidance task force. This involves additional funding for 1,300 staff to focus on specific issues dealing with anti-avoidance law, diverted profits tax, the Top 100 and the Top 1000 program. We've got combined initiatives dealing with Justify Trust, country-by-country reporting, spontaneous sharing of information, and the reportable tax position schedule. It's just part of an overall strategy to really manage public groups and international tax compliance and give the ATO the ability to do so. The ATO supports transparency and provides certainty through tailored guidance to business, which details specific ATO concerns. There is a measured shift away from tax rulings, focusing on legal interpretation, to taxpayer alerts and practical compliance guidelines. Specifically, this allows us to head off future non-compliance by providing taxpayers with the ATO view in relation to particular arrangements and particular risk indicators. Examples of taxpayer alerts are listed on the slide. It's not an exhaustive list. Taxpayer alerts outline a structure that the ATO is not comfortable with and allows taxpayers to see the nature of particular arrangements that the ATO considers are risky and high risk and will be devoting compliance resources to. They're usually tax risk and arrangement focused and not pharmaceutical specific. However, can easily apply to specific pharmaceutical companies who have engaged in any of the arrangements listed. Our Practical Compliance Guideline program allows taxpayers to risk assess particular structures and arrangements so they can see how the ATO will risk assess the same arrangements. Moving on to the Justify Trust and the Top 1000 program. Justify Trust is an OECD concept listed on the slide is the quote from the OECD on Justify Trust. Essentially, it's about obtaining a level of assurance that the right amount of tax is being reported and paid. From the ATO's perspective, that assurance means that we are confident that taxpayers are paying the right amount of tax under our tax laws. It is a bit of a shift in thinking. It's not necessarily about finding risk. It's about having the confidence that there are no risks to be found. The ATO is applying this concept across our top 100 and top 1,000 taxpayers using selected indicators that I will run through shortly. Justify Trust is important, particularly because of the large corporate tax concentration for the public groups and international and large business area. While total company income tax is $67 billion, you can see how, on the slide, that is actually broken up amongst the population. The largest 10 businesses pay $20.4 billion of that. The largest 100 pay $33 billion, and the largest 1,400 pay $40 billion. And so you can understand the ATO's focus on the top 100 and the top 1,000 taxpayers in public groups and international. Quite recently, particularly last week, on the 11th of October, we published our Tax and Corporate Australia publication. It's available on our website. It is Public Groups and International's key external publication, bringing together ATO initiatives and the information that we have which supports our view of the high level of compliance among large corporate groups. We published our tax gap. This is an estimated tax gap for the 2014 and 2015 period. We have assessed that the tax gap for that period is $2.5 billion, which is essentially $5.8 billion of the collection that we get from large corporate groups. Estimating the tax gap helps us to think about what we're doing, what we're not doing, and what we can do better. And it's a shift in focus. It involves less emphasis on audit results and more on making it easier to comply with the law. It helps us guide what the priority risks should be for the organisation and the opportunities and where to invest our resources. So this just pictorially demonstrates the way that the ATO approaches Justify Trust for the top 100 and top 1,000 population. As I said, the level of assurance that the ATO is expecting is a level of confidence that the right amount of tax is being paid under our law. And we use 4 pillars to do so and gain a holistic understanding of business operations, and we use the 4 pillars to assess the level of assurance and confidence that we have. The level of confidence using these 4 pillars is a combination of technical and accounting aspects, as well as consideration of taxpayer behaviour, advisor behaviour where relevant. The 4 pillars really are listed on the slide, but are essentially tax risk governance framework, considering the tax outcome of new or large or unusual transactions, considering specific risks that the ATO has published in the market, for example, in our Taxpayer Alerts, and considering tax and accounting reconciliation items and the alignment or misalignment between tax and accounting. So those 4 pillars are assessed to determine the level of assurance that we have over a taxpayer's compliance.
Sandra, I might just go back. We have had a question in respect of the OECD quote showed earlier. Someone has asked, when we talk about reasonable judgment, is this in respect of an informed ATO person or the punter on the street? So I think this question's going back to the quote from the OECD practical guide about justified trust. And whose perspective is it when we talk about reasonable judgment of a taxpayer?
Insofar as it relates to the public groups and international population, which are the largest taxpayers, corporate taxpayers in Australia, what we would call our top 100 and top 1,000, we are looking at well-advised and sophisticated taxpayers who understand the law and have access to resources to allow them to understand and comply with the law. So it is a higher threshold than what we would expect the punter on the street to have.
Thank you.
The Top 100 program is a program that has been running for a while, in the sense that public groups and international business line has always had a focus on our largest taxpayers. It involves 100% coverage and a one-to-one coverage. We've got a key engagement strategy which involves compliance reviews and pre-compliance reviews and ongoing engagement throughout the tax year, and both before tax returns are lodged and after tax returns are lodged. And for some taxpayers, that may involve ACAs. The population can be fairly dynamic, but there's often a consistent population within our largest top 100 taxpayers. The Top 1,000 program, this involves a much more dynamic population, essentially focusing on taxpayers whose revenue exceeds $250 million turnover. There will be an annual refresh of the population, but as it stands, we have identified that population to make sure that we can get 100% coverage of them over the next 4 years. So that the plan with the Top 1,000 program is to undertake compliance reviews of the top 1,000 taxpayers over the next 4 years with 100% coverage. That program has commenced and will continue to be rolled out over the next 3 years. We are a year in, and both the Top 100 and Top 1,000 program will essentially cover the 4 pillars that were addressed in the previous slide.
So Sandra, what years would that be covering? If it's happening over the next 4 years, do you envisage that might apply from what FY13 to pick a number up to current, or is there what does?
In terms of the years which will be under review?
Yes.
So my understanding is if there are taxpayers who are currently subject to a top 1,000 review, it involves the last two lodged tax returns. I will have to take on notice if taxpayers are subject to a top 1,000 review in later years, whether it will involve more years.
Yeah. Thank you.
So moving on to specifically on our pharmaceutical strategy. As Chris alluded to, why a pharmaceutical strategy? As everyone knows, 9 pharmaceutical companies, colloquially known as the Senate 9, made submissions to the Corporate Tax Avoidance Committee asking where they were explaining their tax contributions to Australia. And whilst the inquiry focused on other taxpayers, such as the mining and the e-commerce industries, the committee was particularly critical in its assessment of the pharmaceutical industry. Just a quote from Senator Dastiari: "How is it acceptable or appropriate that a company," and again these are all public figures, a company which has a total revenue of $1 billion is able to engineer its affairs in a way that it had an income tax expense last year of only $1.5 million. It just does not seem believable. In the Gaming the System interim report, again, a specific testimony of senior pharmaceuticals was quoted, which said, and the report actually said, the committee was dumbfounded to learn that the executives of a number of multinational pharmaceutical companies knew almost nothing, if anything at all, about the transfer prices of identical products supplied to other international subsidiaries. The committee drew further adverse conclusions regarding the pharmaceutical industry and the aggressive tax practices and structuring and the use of transfer pricing, debt, tax havens and IP migration. So the ATO response has been to have a particularly targeted strategy in relation to the pharmaceutical industry, and I'll run through that strategy shortly. Just some statistics. Obviously, we've got 21 cases which are live at the moment. This includes 13 audit products, with the rest being APAs. At a broader tax task force level, we have 60 audits in the task force covering 54 companies.
Sandra, just before you leave that slide, we did have a question from one of the participants. How many top 1,000 taxpayers has the ATO completed its review for? And sorry to send you questions like this without notice.
I don't know off the top of my head how many top 1,000 reviews have been completed. I think more than 30% have either commenced or at least been profiled, but I don't know how many actual cases have been completed.
So is it fair to say these reviews are still in the early stages then? Because if you've commenced 30, you've got another 70 still to do. So this is when did this start? The
top 1,000?
Yes.
I think it was for it started about, I'd have to say about 14 to 15 months ago.
Right.
So we're beyond one whole financial year.
Yep.
And obviously the work continues to move along.
Yes.
But I don't know exactly how many have started.
Right.
Or been sort of commenced or finished.
Yes.
So moving to specific tax issues that we are looking at in the pharmaceutical strategy, we'll touch on transfer price R&D and mergers and acquisitions. At a really broad level, our pharmaceutical strategy, insofar as it relates to inbound transfer pricing, is the application of the arm's length principle. And what we're really trying to do is to accurately delineate the associated enterprise transactions and the commercial and financial relations to identify arm's length conditions. This involves a holistic understanding of the industry, the business, value chain, business drivers, value creation, as well as the activities undertaken in Australia and the assets and risks which are managed and controlled in Australia. We will apply the arm's length principle to the substance of transactions and will only respect contractual allocation of functions and risks if they reflect the substance. At a really broad level, that is our transfer pricing strategy for pharmaceuticals.
Sandra, we've had another questions come in just off the back of what we were talking about a few moments ago, and someone has asked, does this mean that a small pharmaceutical, let's say less than 100 million annual turnover, does not need to worry about a review?
So the ATO, as I said before, the ATO has published a lot of taxpayer alerts on aggressive tax planning features and has other guidance on tax planning arrangements. To the extent any company engages in what the ATO would consider high-risk transactions, there is no, I suppose, safety threshold or safe harbour insofar as it relates to risky behaviour. A taxpayer with a $100 million turnover will not, say, fall into the Top 1000 program. That's definite. But the Top 1000 program is just one element of the broader compliance strategy undertaken by public groups and internationals.
Yep.
So what we've done in furthering our transfer pricing strategy for pharmaceuticals also involves ongoing consultation with advisors, industry associations and experts, government departments and overseas tax jurisdictions. We've also undertaken a comprehensive analysis of the pharmaceutical industry itself to make sure that when we are talking about the industry, we've got a good sense of the subsectors and the differences in the pharmaceutical industry themselves. So we understand that we can't paint all pharmaceutical companies with the same brush, and that when we are talking about pharmaceuticals, we are really talking about distinct and discrete separate sub-industries dealing with patented drugs, generic drugs, medical devices, over-the-counter, and possibly animal health. So we understand it's broad, it's dynamic, and it's not a one-size-fits-all approach. So when we say accurately delineating the transaction, there's a question of what does this mean in practice, and what are the red flags that the ATO might be looking at in order to determine whether a pharmaceutical company would be subject to either an audit or a review. We want to understand the global value chain and the entities that are undertaking core functions and managing and controlling assets and risks. At a really simple level, characterisation as a limited risk distributor with a default T&M transfer pricing methodology is no longer appropriate. We've identified 3 key value drivers in the pharmaceutical industry, being the intellectual property, the regulatory framework, and the sales and marketing activities. And we will seek to understand which entities are driving each of those core values and the relative value of each of those. Regulatory relationships and sales and marketing are not always routine and can be value-adding, value-generating, giving rise to assets and risks which are not always acknowledged. We know that the industry is highly regulated and subsidised through the TGA and the TBS, and we've devoted resources to understand the interaction between the regulation and commercialisation in the Australian market. Some of the things that we've seen in practice that have caused us red flags: where we have vertically integrated value chains and value creation. It can be hard to identify which entity develops, exploits, manages, protects and enhances assets, and which entity manages and controls the risks. The Australian business is not merely some standalone arm of the broader business, and there is value from having Australian subsidiaries and running operations through an Australian controlled subsidiary. The concept of a limited risk distributor with no genuine attempts to differentiate between segments and activities. A generic drug, for example, or a disposable medical device are not the same as a patented rare disease drug or an active implantable medical device. Over-the-counter is not the same as a PBS drug either. It's not a homogenous industry, and we do want taxpayers to genuinely consider the value creation that they're adding to the business. We'll also give consideration to the KPIs and value drivers of the Australian business and Australian personnel. Again, at a rudimentary level, you would expect that the Australian company would be rewarded in a similar manner to the personnel are rewarded.
So Sandra, just a question if I may. I think you mentioned earlier that there are 21 current cases in the pharma sector being actively considered by the ATO, of which 13 are audit products and the rest are APAs. Are you able to give an indication as to how many of that 21 go to pricing of product, if I can put it that way? I imagine the APAs would all be pricing of product. The audit cases, I'm guessing, would be majority pricing of product, or would that not be correct?
All the audit cases involve transfer pricing of products.
So the 21 cases, all of them, we could say, involve have an aspect to them of pricing of product.
That's correct. The issue is not only pricing of products. There may be other issues, including consolidation, thin cap, etc. But all of them do involve the pricing of related party transactions. And
are you seeing, again, I'm sorry, these are questions without notice, but I'm sure they're going to be of interest to all the webinar attendees. Are you seeing diversity of approach amongst farmers to how these things are dealt with, or are you seeing certain trends?
There is a great diversity of approach amongst pharmaceutical companies themselves. If we sort of take a step back to the Senate committee, where I think Commissioner Jordan mentioned, the sort of the test of 4 to 8% EBIT is what he would consider reasonable.
Yes.
We see a lot of pharmaceutical companies within that range, and we see a handful at the top end of the range.
Yeah.
Yet we also see, and surprisingly, we see quite a few large pharmaceuticals and functionally intensive pharmaceuticals well below that range. So there is a significant divergence in the way transfer pricing guidelines have been applied by pharmaceutical companies.
And of course, the ATO is privy to, it sees this information from the different pharma companies, but the pharma companies, of course, don't share that. They're on their own. They know their information. They'd like to know their competitors' information, but they don't. So how does a pharma company go about, if it wants to, finding out where it sits on that spectrum of pricing? Is it appropriate for the pharma company to be able to obviously the ATO has very strict secrecy rules, but is it appropriate for a pharma company who's under audit or in an APA to ask the ATO where it sits in the spectrum of the pharma industry?
I think that would be a good question for a pharmaceutical company to ask the ATO, because rightly so, as you said, they're probably not in a position to understand the industry, the broader industry, like the ATO, purely because of access to data.
Yes.
I would hope that their advisors, particularly their transfer pricing advisors, would be giving them an indication of what is being seen in the market, particularly what is being seen from some of the ATO sort of dissemination of information from the ATO. You know, as a cluster, as a sort of a strategy, we've gone out and we've spoken to the Big Four. We're doing this webinar. There is a lot being produced from the ATO about expectations. We're conscious that it isn't. It's not a numbers game. It's not about putting a number out there and saying that all pharmaceutical companies need to hit a number. Each pharmaceutical company does need to undertake a genuine exercise to understand their business, apply the guidelines, and we do want to provide guidance to pharmaceuticals as to the features or the things and indicators they should be looking at when undertaking that exercise.
Yep. Thank you.
Just continuing on with some of the transfer pricing observations that we've seen in our work. When we highlight the importance of the regulatory activities, we're often told that those activities can easily be outsourced. However, there's little evidence to suggest that those activities would in fact be outsourced. And what we can see is that health economic departments are quite large, they're core to the business, and they involve highly skilled personnel. And we can also see that it's quite integrated with the other value drivers.
Sandra, I've got a couple more questions from attendees. One is from Arthur, and Arthur, I'm not going to ask Sandra that question because I'm asking Sandra to give advice, and I don't think she's going to want to answer that one, so I'm not going to put her on the spot with that. My apologies for that. I have another question. Will the compliance reviews for the top 1,000 be purely from an income tax perspective, or will they also encompass indirect taxes such as GST? Which is a good question.
My understanding is the focus of the reviews is income tax compliance, but we do undertake a holistic view of the business. So if we do identify GST issues or even other, say, excise issues, we will definitely flag those issues and take it up with the most appropriate people. We don't want taxpayers to be subject to multiple review products by the ATO. So to the extent that we can have a one ATO approach, we will. So just continuing on with a couple more transfer pricing observations. We often get questions in relation to the ATO seeking broader value chain information. Again, we will always ask for related party agreements within a broader value chain, segmented accounts, financials, and try to understand the roles and responsibilities of other companies in the value chain. We may even seek to speak to offshore people sometimes. Another issue is the ATO's request for agreements with independent parties, which may inform the ATO as to how independent parties might behave. For example, we know in the pharmaceutical industry, co-marketing agreements and co-development agreements are quite common. So we will always try to find cuts where we can. And although the standard of comparability is high, it's not so high as to render the methodology impractical. So we will always ask for the information. And it's not a defence for a taxpayer to advise the ATO that they have considered those agreements to be not comparable. One other issue which we come across quite often is that taxpayers are limited risk because their contractual arrangements guarantee an operating margin return. The ATO view on that is it's not acceptable to purport that the transfer pricing mechanism can drive the allocation of risk, and the control and management of risk has to occur before application of the transfer pricing methodology. Research and development offset. We're not going to have an exhaustive presentation on eligibility for the offset. There are teams within the ATO whose expertise is R&D, and it is a major focus for the ATO, which has also been covered by various taxpayer alerts. Insofar as it relates to the pharmaceutical industry, we have observed an inconsistency between the characterisation of payments for transfer pricing purposes and their treatment and character for R&D offset purposes. Specifically, for transfer pricing purposes, certain payments which are paid to third parties are treated as pass-through for TP purposes, and they're not included in any cost base that is marked up in terms of the related party transactions, but they are included in the cost base for R&D offset purposes. The ATO's indicative view of this is that if the expense is managed and controlled in Australia such that it's eligible for the offset, then we consider that the same treatment would apply to its transfer pricing characterisation. In a sense, it no longer carries with it a pass-through characterisation.
Just on the R&D, Sandra, it sounds from what you've said today that many of the pharma reviews and audits that are happening now have a TP aspect to them. Many, probably most, if not all. But with R&D offsets, is this something where you're seeing isolated examples of this, or is it coming up regularly in the pharma sector?
So the particular inconsistency I mentioned does come up quite regularly. It is a pattern and trend that we have identified.
Right.
Not every pharmaceutical company treats expenses in this manner, but it's enough. We've seen a consistent enough population doing it that we do consider it an issue, and it is something that we are looking at.
Right.
I only list it here because I don't want to go through necessarily all the rules in relation to the eligibility for the R&D offset itself. That is something that doesn't really sit within our pharmaceutical strategy, which is focused on transfer pricing. So I don't want to go through the rules. But R&D and things like clinical trials are a core part of every pharmaceutical business. And so there's enough of a population.
Yeah.
We do look at R&D. We do look at the offset, and this is an element that we have identified as a particular risk for pharmaceuticals.
Okay, thank you.
One other thing that we will also do with contract R&Ds and clinical trials is to undertake a critical analysis of the nature of the activities as well. This will inform the most appropriate methodology. Again, while a cost-plus methodology has been the methodology which is used most often to price these transactions, and we're not saying that it wouldn't be appropriate in the circumstances. We will consider many factors in determining the right methodology, in looking at the very nature of the type of activities which are undertaken. And we will consider the nature of the work that is being undertaken in Australia, diversity and totality of function, the level of supervision and integration with other global clinical trial centres, contribution to standalone global and marketable projects, and the end-to-end development management and review of project deliverables. So I don't think it's enough to just say to the ATO, this is contract R&D, and therefore we think cost plus X% is the right answer. We will definitely look at whether the cost plus methodology is the most appropriate methodology, especially in light of the new guidelines insofar as they relate to the DEMPI function that we referred to earlier. Another major sort of topic that we come across in pharmaceuticals pharmaceuticals relates to mergers and acquisitions. There's always a lot of activity in relation to mergers and acquisitions in the pharmaceutical industry. And although one of the core risks of the pharmaceutical strategy is transfer pricing, we do want to identify systemic risks and other tax risks that could impact on the amount of tax paid. And definitely mergers and acquisitions gives rise to a raft of tax risks that will also be looked at by the ATO, including ThinCap, related party debt financing, consolidation and valuations, IP migration, and capital gains tax.
Are we saying, Sandra, these sorts of issues are particularly prevalent in the pharma sector at the current time, or is it fair to say that those issues would be there across all industry sectors? I mean, it may be, as I understand it, the pharma sector is going through a bit of a consolidation phase at the moment with M&A activity happening, and I'm just wondering if that's just a product of the fact that that's what the industry is doing, or are you saying there's something specific around M&A activity for farmers that stands out over and above other sectors?
I don't think there are any specific tax risks that arise in relation to mergers and acquisitions of pharmaceuticals. For example, if we look at IP migration, that can cut across multiple industries.
Yes.
There is an ATO strategy being developed for IP migration, and that could include pharmaceutical companies and other companies. Yeah. So my answer would be there is nothing specific. There's no specific tax risk that applies only to pharmaceuticals.
Yep.
No specifically observed behaviour or arrangement or structure.
Yep.
But possibly for the reasons you said, there does seem to be a period of significant mergers and acquisition activity, which has given rise to some cases focusing on these risks in the pharmaceutical industry.
Right.
Briefly touching on advanced pricing arrangements. They're a very important part of our ATO strategy to provide certainty and forward-looking compliance for taxpayers. We do encourage taxpayers who genuinely want certainty over the pricing of their related party transactions to approach the ATO for an advanced pricing arrangement. However, I think our Commissioner Jordan mentioned at one of the Senate committees that it is a privilege and not a right, and we have issued a practice statement which goes through some of the expected behaviours for taxpayers who wish to be part of the APA program. I will run through some of the things that we've seen in some of our pharmaceutical APAs.
Just before you do that, Sandra, I've heard from clients, I'd be interested in your comment on this. There seems to be a feedback that APAs are becoming harder to obtain with the ATO than it was the case a few years ago. Do you have any comments or observations on that perspective?
So I think we've definitely changed our approach to APAs because we are providing future certainty for taxpayers. We take the process quite seriously. But the other point with APAs that maybe has changed is our focus on collateral issues and even our internal process insofar as it relates to APAs. So, for example, one thing we will definitely look at is the full breadth of tax risks that we're seeing. So, for example, we may have a taxpayer who approaches the ATO for an APA on one related party transaction and decides that the other 90% of its business it wants to keep outside the APA. You'll find that the ATO's approach to that will be either we get a holistic understanding of the business and therefore include all related party transactions in the APA, or there will be no APA. Right. So that's just sort of an extreme example, but we have seen examples of taxpayers cherry picking the transactions that they would like covered by an APA and leaving outside other transactions, or undertaking, they could be entering into an arrangement where they approach the ATO for sign-off on pricing, whereas we might identify consolidation, fin cap, and other risks that need to be dealt with before we can even get into the issue of the arm's length conditions. So they're just two examples, but you'll definitely see a more robust response from the ATO in terms of how it treats APAs. We also want to ensure, although we treat each APA on face value, as applying to a particular taxpayer, we do have, say, a pharmaceutical strategy or even an e-commerce strategy. So there's a certain level of internal consistency that we would expect to be seeing across the industry in terms of both pricing and even how cases are undertaken by ATO teams. As I said, just some recent examples. We've seen taxpayers who have been ejected from the APA program because of their failure to provide information. That particular taxpayer was subsequently let back in after demonstrating cooperative behaviour and providing the information. Another one that we saw was a taxpayer who lodged an APA application after receiving a high-risk rating in a client risk review. That high-risk rating is specific to their transfer pricing methodology and the application of that methodology, yet the APA application, the proposed transfer pricing methodology and application was exactly the same as that in the client risk review, despite the ATO having indicated that we thought that was a high risk. Sometimes we also see APA applications where the proposed application of the transfer pricing methodology is a reliance on a global transfer pricing document without any underlying thought to what does the Australian value chain look like and the functions that sets risk for the Australian taxpayer.
Just a reminder to people listening in on this to feel free to ask questions. I fear that in not having asked Arthur's question before, I've scared everybody off. That should not be the case. So please, if you've got any questions for Sandra, send them through.
So moving on to some of the key transparency measures and other measures that the ATO has recently implemented post-BEPS. So key announcements include the multinational anti-avoidance law, adoption of OECD transfer pricing documentation standards, enactment of the definition of SGE and increase in penalties for SGE. 2016 announcements, we've got the Tax Avoidance Task Force that I mentioned, the Diverted Profits Tax, strengthening Australia's transfer pricing rules, the hybrid mismatch rule, and spontaneous sharing of rulings in 2016. Country-by-country reporting. Purpose is to assist transfer pricing post-BEPS, focusing on the BEPS implementation, our implementation of BEPS Action Item 13. It's designed to give a 360-degree outline of the global business and transfer pricing policies. Country-by-country reporting, it involves the CBC report itself, the local file and the master file. No duplication of information is intended, with administrative solutions to streamline information provision under consideration. For example, the interaction between the local file and our IDS. Exemptions are considered on a case-by-case basis and aligned to whether a reporting entity needs to lodge a report. There is an upside to the investment by a taxpayer into this program. The ATO lighter touch and supporting assurance, and when we do identify any risk, we can have a more targeted compliance product.
Sandra, I have heard, and this is a most unfair question to ask you, it's not come from any of the webinar attendees, but I have heard it said on a number of occasions, gosh, the ATO has CBC reporting, RTP schedules, new MAL, diverted profits tax, hybrid mismatch rules, strengthened transfer pricing provisions, strengthened Part 4A, and yet we have the Commissioner and Jeremy of late saying the corporate sector are largely paying the right amount of tax, or as Chris will put it, we're governing for the 95% of the corporate sector who do the right thing, and he's more concerned about issues that come down at the smaller end of the market, the cash economy, all those sorts of things. It's interesting, isn't it, when we go through all these relatively new provisions, one that have come online this year, last year, or the year before, there is certainly a greater toolkit bestowed upon the Commissioner for pursuing corporates, and in this instance, that this applies to the pharma sector, in circumstances where there's one might see some inconsistent messaging coming through that, by and large, the corporate sector, per seniors in the ATO, is doing the right thing, and yet there's all these extra regulatory reporting requirements being placed on the entire sector. So when Chris says we should administer the tax system for the 95% who do the right thing, it seems that we're actually running it from the perspective of the 5% who aren't doing the right thing.
If I unpack the references to that toolkit that you provided, there's really two themes. One is a toolkit to foster transparency, and that's very much part of the global consensus. So CBC reporting, even the RTP schedule and what it's designed to do, it is meant to foster a greater transparency from taxpayers. But if I focus on some of the specific tax laws that you quoted, for example, the multinational anti-avoidance law, the diverted profits tax, even the hybrid mismatch rule, they're all aimed at quite aggressive behaviours and aggressive tax planning and tax structures. So my response would be, I would hope that the 95% of taxpayers who are doing the right thing don't need to consider the MAL or the DPT or the hybrid rules to a very large extent, because the toolkit is designed for the 5 that aren't complying.
Understand.
The other point, just touching with the CBC reporting, is the possible application of the new SGE penalties. There are concerns around penalties being disproportionately high for honest mistakes, and we're committed to a manual application of penalties to ensure that they're applied reasonably.
We've had a question on CBC reporting. The question is, does an Australian entity need to lodge the local file even if the GPE is not an early adopter of the CBC reporting? I'm glad they asked you that question and not me, Sandra.
I think my understanding, and without having to take it on notice, because I would prefer to provide an answer, is there is a transitional exemption where the GPE is not yet required to lodge a CBC report. So the entity can apply for an exemption.
Right, okay. And then somebody just submitted saying, yes, I assume that means they knew the answer and you got the answer correct, Sandra, so well done. I've got a comment, transitional only applies to master file and CBC R.
The question was, though, if the GPE is not required to lodge the CBCR, the actual report, does the Australian company need to lodge the local file?
Anyway, there's no need to dwell on it, Sandra. I'm conscious we have 30 minutes to go, and you've still got materials to get through. So it's a fine line between interrupting you with lots of questions and also letting you get through the materials.
Penalties for significant global entities, they're just part of our strategy. I won't really go through them. Policy intent is to encourage SGEs to better comply with taxation obligations, including lodging tax documents on time and taking reasonable care when making statements. Again, the reportable tax position schedule. We do want to get a better understanding of the tax risk for taxpayers, industries in a large market, and helps improve our dialogue with large businesses about their risk profile, corporate governance, and also helps us to focus our compliance activities.
And are you getting that from the RTP schedule? That's been around for a little while now, so presumably...
It definitely has. The Category C, RTP will now ask taxpayers whether they have specific arrangements that we're concerned with. So taxpayers will need to assess whether they have entered into any arrangements which are linked to Taxpayer Alerts, PPGs or LCGs. Mm. Moving on to Diverted Profits Tax. So the object of the DPT is to prevent entities reducing the amount of Australian tax they pay by diverting profits offshore through contrived arrangements, to ensure the Australian tax payable by SGEs reflects the economic substance of the activities that those entities carry out, and to encourage SGEs to provide sufficient information to the Commissioner to allow for the timely resolution of disputes. One question we often get asked is the difference between the MAL and the DPT and why it was felt that we needed a DPT when we had the MAL. One point I often remind people is the UK DPT has two limbs, one being a MAL-like limb and one being a DPT-like limb. Australia just implemented two separate laws. They both operate as anti-avoidance provisions, seeking to protect the integrity of the tax base, but they are targeted at different types of arrangements. So the MAL is looking at the avoidance of a taxable presence. It's aimed at a particular type of structure and arrangement, and will apply where particular gateway tests are met in relation to that structure, which is very much a structure which avoids, which has a non-resident booking sales from Australian customers, where there are activities undertaken in connection with those sales by an Australian company. Whereas the DPT is much broader, is not aimed at any particular type of structure or arrangement, and involves the diversion of profits away, even where you might have, say, an Australian taxable presence.
You know, Sandra, I have heard, again, senior people from the ATO say they hope that they never have to issue a DPT assessment. And yet this slide would suggest it's a hope only because there are revenue projections for the DPT in the slide. God only knows how those revenue projections were determined. It reminds me of when capital gains tax came in and somebody in Treasury said it's going to raise $20 million in its first year. It raised a lot more than that. So do you have any comments on those? Comments on the number of DPT assessments and those revenue projections?
So the revenue projections are taken straight out of the explanatory memorandum. My understanding is they're indirect revenue projections as opposed to direct revenue projections. So they're not projections that will necessarily be the result of a DPT assessment. They are projections which are linked to compliance results or maybe indirect results because of the non-application of DPT or how taxpayers may approach the DPT.
Right.
So there are particular sort of threshold requirements for the DPT. I won't run through how the legislation operates, except to say that it operates on a principal purpose test, and the two exceptions to the application of the DPT relate to a sufficient foreign tax test. That is, basically where sufficient or sort of comparable foreign tax is being paid in another jurisdiction. It's unlikely that one would divert profits to pay the same amount of tax in another jurisdiction. Just one point on that, just because a particular arrangement may involve a comparably taxed jurisdiction does not of itself mean that the sufficient foreign tax test will be met. For example, one may be able to amortise intellectual property in the USA, and that of itself may be a driver to do a particular arrangement, which means that sufficient foreign tax test has not been met because of a particular deduction being sought somewhere. The other exception is the sufficient economic substance test, which looks at the profits of each entity in connection with the scheme and the substance that's being undertaken in each of those entities. We've got a couple of scenarios which we are happy to run through very, very quickly, and they could apply to a pharmaceutical, but could just as easily apply to non-pharmaceutical companies. As I said, the DPT is not aimed at pharmaceuticals or any particular type of industry or structure, but in this scenario, where you have intellectual property which has been licensed to a non-resident offshore, where that entity is able to develop future versions of the intellectual property. This is very colloquially known as a run-up, run-down type of arrangement. Essentially results in old IP losing value and new IP owned offshore, and eventually taking over the value of old IP. This is something that the DPT would be considered in any compliance work, and we would definitely look at the substance in the offshore entity, the commercial reasons for undertaking certain transactions, where Foreign Co is located, as I said, the activities of Foreign Co, and what Australia Co actually receives as compensation. I mean, I think it goes without saying that that type of arrangement is also, it's not just a DPT arrangement. One would be looking even more broadly at Part 4A, transfer pricing, 815B, 81530. I think there's a raft of things that could be considered. Another scenario, again, we've made it specific to pharma, but it could just as broadly apply to any tangible good inbound supply chain, essentially involving a hub. So an Australian company buys goods from a Singapore hub. Those goods are delivered directly from a manufacturer, and Australia Co is designated as merely a limited risk distributor providing routine support, albeit Australia Co is deriving the revenue from Australian customers. Again, in relation to how the DPT may apply to something like this, we would look at the level of staff in each of the entities, the value provided by Singapore Co in this arrangement, the role of Australia, whether activities are in substance undertaken in Australia or in Singapore, and we'll have concerns around the value provided by Singapore Co, considering that the products are manufactured elsewhere and shipped directly from elsewhere. And we'll also consider the contribution of Australia given inventory risk, market risk, customer credit risk, warranty risk, and product liability risk. Again, it's not just a DPT scenario. One would also be looking at the transfer pricing rule.
And Sandra, these two scenarios, is it fair to say that you are seeing these two scenarios or variants on them on a reasonably regular basis in the pharma sector, or is that overstating it?
I think it is early days in relation to compliance activities focused on the Diverted Profits Tax. My understanding is scenarios like this will be found in our LCG and PCG publications. We've tried to take out a couple of scenarios that could apply to pharmaceutical companies. I don't think at this stage there is, not that I'm aware of, an actual case on hand as part of our, say, 20 compliance cases.
Right.
That involves either of these two scenarios.
So these two scenarios, just to be clear, these two scenarios are not lifted from the 13 pharma companies under audit at the moment? No,
they're not. All we've done is tried to illustrate how DPT may apply to a pharmaceutical using structures which we may see in pharmaceutical companies. And both scenario 1 and scenario 2 could easily apply to pharmaceuticals, albeit we acknowledge could also apply to other industries as well.
Yeah. I've got a question here for you. Somebody has asked, why does delivery of the goods from a third party make any difference if the payment for the goods is at an arm's length rate? So I'm not sure if that's going back. That's going back to scenario 2 that they're referring to. But then
I think the point with that particular feature of the scenario is merely trying to articulate the value that Synco would provide. In a sense, what is its role in this arrangement and what is the value that it's providing in the broader value chain if all it does is pay for goods.
Yeah.
One would question when Pharma Australia Co then pays Singapore for goods. One is looking at not just the pricing, but whether there may be another tax benefit. That's the first thing. But the DPT is merely another toolkit to look at what is the value Synco is providing in this scenario.
Yes.
Just moving through DPT, we do have an administrative framework supporting the DPT to ensure that the ATO has significant safeguards and control. We are developing a law administration practice statement which will outline these steps. But the point of this slide is merely to articulate to the broader audience that the DPT is rigorously applied and subject to a high level of oversight.
Yeah, just noting there's 15 minutes to go. Keep the questions coming through, as you'll see, or you will see shortly on the slides. We've got a few slides on diverted profits tax to go. And Sandra, I'm keen to get you to the last slide of best practice risk management. I think the attendees will be interested in that. Craig, I would ask you to reword the question you sent through before, because I couldn't quite understand the question you were asking until I understand it. I'm not going to ask Sandra it, so if you could reword that, that would be great. And Sandra, if I could encourage you, in the remaining 15 minutes, feel free, if pressed for time in terms of the remaining slides, to skip over some of these DPT slides, because I'm aware that some of these slides I've seen in other ATO presentations. But so as we can have enough time to talk at the end about best practice risk management, because I think that's something that the webinar attendees will be interested in. Having said that, Craig's asked the second question as to when the DPT law practice guide will be released. And I'm not sure that is in your slide deck.
I will skip to this slide, which is, I think, what is being referred to. So, obviously, these documents are in development. They are currently with internal stakeholders. We are hoping to publish as soon as we can, and we acknowledge that there has been a delay, but we do want to get it right before we issue it. There has been some limited consultation, is my understanding, but all I can say at this point is it is as soon as we can publish it. I don't have a time frame. So.
I'm going to pick the date 23rd of December because in my experience over the years is whenever the ATO sets a deadline, it's usually by the end of the calendar year, and things usually come out just before Christmas, which has advisors and clients digesting them.
Well, look, as a joke, it can't be the 23rd of December because I don't think we're open then. But,
right. I've also been asked to just let attendees know that Walters Kluwer are planning a network session in March on the PCG for the Diverted Profits Tax. So it's a plug for Walters Kluwer.
Well, just quickly, there are some key stages that the DPT sort of, in issuing an assessment, some key points. I won't run through it. Obviously, everyone will see these once they get the slide pack. It is quite self-explanatory, just run through what would actually happen in the issuing of a DPT assessment. And also just a timeline of key engagement products in the sense of when is DPT being considered in particular compliance products. So you can see that DPT is being looked at in current APA applications and renewals, current private rulings, and current settlements. And as tax returns are lodged, DPT will just become part of the toolkit and business as usual analysis. Again, I think that's pretty self-explanatory. And we've run through that one as well. We often get asked, can certainty be achieved for DPT? APAs is one of the major products in which DPT, a certain level of DPT certainty can be achieved. At the moment, there's a lot of consultation going on in relation to the DPT sign-off, which will be in APAs, and essentially that sign-off, it'll involve a sign-off of a DPT benefit of a covered transaction in relation to certain DPT transfer pricing benefits. It'll be the DPT benefits that relate to income tax, which my understanding are the first three DPT benefits. So there will be a sign-off for covered transactions for those DPT benefits in APAs. Taxpayers who want a broader sign-off or sign-off on other elements of the DPT benefit can request private rulings. So just running through, and this is our last slide, it is just talking through some of the best practice approaches, what taxpayers can do, what are some of the things not to do, and what to expect from the ATO, insofar as it relates to sort of self-assessment by pharmaceutical companies of their tax obligations, or how the ATO will approach compliance within the pharmaceutical strategy itself. I mean, what do taxpayers need to do? We do expect transactions to be genuinely valued according to the arm's length principle and the updated transfer pricing guidelines. and that is a, it does involve, it can be quite difficult. The guidelines are quite extensive, and there's been revisions and updates to those guidelines, particularly as they relate to risk identification, risk allocation, and the DEMPI functions that I referred to earlier, and how the ATO and how taxpayers should actually go about accurately delineating transactions. Another way to make sure that taxpayers are self-assessing themselves for transfer pricing purposes appropriately is to engage with the ATO early to achieve assurance and certainty. Again, the APA program is the most appropriate program to do so. What we thought we'd do is maybe, again, just run through some of the examples of behaviours that we've seen in some of our compliance work, specifically pharmaceutical compliance work, really as examples of what not to do. One thing that we're quite sort of strong on is that ignorance is no defence. The ATO has published Taxpayer Alerts, PCGs, there is our broader toolkit as well, as just mentioned, to keep advisors and taxpayers informed of the risks that we're looking at and our concerns. And so, although it's a self-assessment environment, there are a lot of tools out there for taxpayers to see what it is that causes the ATO red flags. As always, if unsure, approach the ATO. A specific example of what not to do that we've seen, we had one of the taxpayers in the pharmaceutical industry under audit, changed advisors, and it would appear that the advisors recommended a new engagement strategy with the ATO, which essentially involved not giving us information. The ATO has significant powers to obtain information, and we will not just use our formal powers in our 353 powers, as we call them, but we will also use our offshore information notice powers and our exchange of information processes under our treaties. So if we need information, we will use the full extent of our powers to obtain that information. Now, another one is where we identify risks in a risk review which are flagged for audit, and a taxpayer seeks to try to resolve all those risks pre-audit. We will always try to resolve matters, but we need to acknowledge that some risks need to be fully reviewed, and taxpayers need to understand that when the ATO wants to undertake an audit, it's because there's often factual uncertainties which sometimes can't be resolved through a quick product like, say, a voluntary disclosure. So we do need to make sure we have access to all the information we need to determine what the ATO view is before we're prepared to resolve any particular issue. Again, we had another case where we requested a third-party agreement, so agreements that might be held globally with third parties. This was as evidence of how independent parties would behave. Again, the response that was received from the taxpayer was, well, we've assessed that they're not comparable, so they're not relevant to the ATO. It is the ATO that determines comparability, so it's sort of a self-fulfilling prophecy if you're going to say that to the ATO. So if there is an issue as to the breadth and extent of information requests, again, the ATO is always open to talk about narrowing or sampling or other methods, but a blanket response which says, well, those agreements, for example, aren't comparable, therefore we don't need to give them to you. Again, that's not an appropriate way to deal with the ATO. What can you expect from the ATO? Guidance on how new measures will apply. We'll always think about the level of guidance we can provide. One thing that we are considering is that the nature of transfer pricing guidance that we can provide for any industries within the inbound supply chain risk that we see. That's a hard thing because it is such a broad issue and covers so many industries, but it is something that we're currently considering in terms of providing practical guidance for how the ATO works. And just where we do see inappropriate behaviour or unacceptable behaviour that may be delaying or trying to ensure the ATO doesn't get access to the information it needs, the ATO will take appropriate steps as a response. And that is the end.
Well, that timing is excellent, Sandra, because it's just a couple of minutes to go before 2 o'clock. There are no further questions that have come through in the last few minutes. So we've covered a lot in the last hour and a half with Sandra. We've had importantly, some practical insights into what is happening in the pharma sector at the moment. We've learned about the justified trust emphasis within the ATO, APAs, tax transparency, all the initiatives going on there, the Diverted Profits Tax, which has just come into our law. So there's been a lot has been covered. Normally in these sorts of sessions, the chair would ask the audience to thank the speaker in the usual way. That is impossible in a webinar. So it just falls to me on behalf of all of you listening in to thank Sandra for taking the time out to talk to these sorts of issues. I'm conscious, just as I've been speaking, there was a question that's come through from David to you, Sandra. When do you expect the 13 audits currently being undertaken to be completed?
So they're at various stages.
Yeah.
So some of them we're hoping will be completed this financial year, but others will go into the next financial year.
Yes.
There is also just a previous question that was asked in relation to how many of the top 1,000 cases have been completed, and I've just gone back through my notes. There's currently 100 underway and 30%, so 30 have been finalised.
Right. So I think that was close to your estimate, wasn't it? Yes. There has been another question come through, which I think is a good one. Is the ATO mindful of the compliance costs these various measures and reviews are placing on taxpayers?
Look, I mean, the ATO is always mindful of compliance costs and the costs which taxpayers need to go to in order to comply with the laws and new measures. Repeating what I said earlier about some of the new legislative measures, I mean, we're not policymakers, so we're not the ones that are introducing the laws, we're administering the laws. We try our best to put out as many or as much guidance products as we can, hopefully to facilitate ease of compliance. To the extent we can put out practical compliance guidelines, it is to allow taxpayers to genuinely consider how, with the least compliance costs, they can comply with certain laws. I can only reiterate that things like the MAL, the DPT and hybrid mismatches, they are designed at aggressive structures. And so to the extent we put out guidance products, it is probably to give as much guidance to those taxpayers who probably don't fall within the scope of the law to quickly self-assess themselves out of it. So that's one of the key things that we're trying to do is filter out those taxpayers who don't really need to spend too much time and too much effort considering the application of some of these laws.
There also seems to be a lot more talk these days about safe harbours in various new areas to assist with this point around compliance costs, because it is a good one, and it is a common complaint from taxpayers now at the top end of town of just keeping up with these raft of measures and the inevitable compliance and administrative activities associated with them is just a drag on business. So I think in that respect, safe harbours and the like are helpful. Appreciating, as you said, that the ATO administers the law; it doesn't make the law. There is another question. What has been an average timeline of the completed audits from start to finish?
So all the audits that fall within our pharmaceutical strategy are in progress. The ATO's benchmark for an audit is 18 months. When we're dealing with issues that are as fact-specific as transfer pricing, that can often take longer, but the benchmark is 18 months, albeit acknowledged that it may take longer.
All right, I'm conscious that it has gone just past 2 o'clock and nobody ever thanks people for going overtime. So thank you all for dialing in. Thank you to those of you who asked questions. And once again, on behalf of all of you, a big thank you to Sandra for taking the time out of her busy schedule to come down and talk to us about all the current tax issues impacting the pharma sector. We'll leave it at that for the day. Thank you.
Thank you, Chris, and thank you, Sandra, for this great presentation today. To all our attendees, have a great day.